Mike, can you hear me now? Okay, audio check. Am I coming through?
Yes, you are.
Okay, thank you. Yes, go ahead and stop the timer. All right. Apologize for the rough start, everybody. Hang on a second. Okay. There. Welcome everyone to Charts and Chats with me, Gordon Scott, and you. I'm glad you're here. I've got some really interesting stuff to cover. We've got four things I want to cover today. Number one, I think the markets are setting up for a bullish rebound, at least to start. I'll show you why I think that. Number two, we've got a guest, Lincoln Holbrook, very good friend of mine, master coach, somebody who's coached students at trading for over 20 years, and we're going to hear from him. I can't wait to introduce you. The next thing I'm going to cover is an earnings preview. Oh, no. Hopefully, before I get to the earnings preview, I'll get a chance to continue a discussion of the Doomsday Trade that I introduced to you last week. You get into more detail on how I'm already implementing that, so you can get an idea of how that's going to go and how you might even be able to track it along with me. And then we'll talk about earnings. Hopefully, we've got enough time to cover all of that today. But first, let's start right here with the NASDAQ and Australian dollar Japanese yen comparison. As you know, I like to look at these two because they're 75% correlated. So what we've got right now, right here, this is the 25th. This is the weekend break. Hopefully you can see that on my screen. I'm just looking at that chart. Well, I'll get to the weekend break in a minute as I share the screen. But first, I want to show you this thing right here. This drop. This is how the week ended. As a reminder, the U.S. markets dropped heavy on Thursday, right in the middle of the day. Not any particular big news, except the news that the Biden administration is considering raising the capital gains tax rate. The highest end of it would be people who end up paying almost 50% in taxes. 50%. Kind of crazy to think about that, but they're already getting taxed under ordinary income somewhere close to those levels. In theory, people at that level, of course, they find lots of ways to reduce the exposure to that. But for those people that have the ability to make money in the stock market, if you earn over $400,000 a year, so these are top end earners, of course, and farther on beyond that, they would have to pay almost half of the money they make in the stock market to the government in taxes. And this doesn't matter whether it's short term or long term. Now, this would be especially the people that held for a year. Those of you who know my whole 56-week pattern thing, it's based on the incentive that people get for holding for 1 year. This effect would take away the incentive to hold for a year. It would also really hit the gains of people who are in the markets with trading regular stocks. And so, big drop happened. Yeah, that was a big drop. And that tells you what the market thinks of the idea. They don't like it. But that being said, very next day, markets rebounded right back up here in the NASDAQ. Now, this didn't affect the Aussie yen, which is highly correlated. It didn't have the same kind of effect here. You don't see this big drop and this big rise. Mild, similar, but that's, trailing off of the NASDAQ, right? So that's how we know that's kind of what was going on there, was stuff that didn't affect the currency markets. So with all this in place, with that as backdrop, people feeling a little nervous about what's coming in the future, but still eager to go ahead and buy the dip, right? That's the first signal that we have, that we're probably setting up for a bullish week ahead. The second signal is, if you look at what's happened, I'm going to go ahead and share my screen here on this one so that you can, so I can get closer up view. Okay. All right. So hopefully what you're seeing here is not the endless. Yeah, hopefully you're looking at my charts directly now, and you just got me up in the upper corner looking down at the charts, right? That's what I'm hoping to see here. And let me get back to the chat window. Are the meeting controls? Oh, that's a little interesting. Oh, there we are. You are screen sharing, it says. Fantastic. Okay, now, by the way, if anybody who's on the call right now would be willing to share, if you've been joining the past 2 or 3 weeks, then you've seen me do a couple of different formats. One where I'm, just looking at the camera, showing my TV screen behind me, and others where I'm just sharing it directly, and I'm this thumbnail up in the corner. I'm not sure how the experience looks for you. I'd love it if anybody would chat feedback. What do you like? Which format is better? Are they all the same? Is it clear enough? Any kind of feedback on the presentation would be greatly appreciated. Just chat it into the window if you get it. All right. For now, I'm looking at the screen, and I'm just sharing with you what we're seeing here. What I want you to notice is that really close up, we've got this move from the beginning of the weekend, the future start right here. And what has the NASDAQ been doing? It's just kind of been drifting lower. It's kind of about flat, exactly flat, but it's just got a general lower drift to it compared to the Aussie yen, which has a rather strong upward bias to it for the weekend. Um, all right, thanks, Chen. Much clearer. Can the weekly pivot be plotted in trading view as shown by Gordon? Weekly pivot in trading view. I'll look to get that in there. I don't have that up there right now, but yeah, yeah. All right. We'll help me with that. If you are talking about like the daily wave runner stuff from ATW, then yeah, I could get that on there. I don't have that now, but I'm sure we can figure that out. And but if you're talking about something else, then let me know because I'm not quite sure. Anyway, all right. So the big thing is that the movement for the Aussie yen is up, and the movement for the Nasdaq is kind of down, and that's not going to stay that way. I mean, it could stay that way indefinitely, of course, but it's not likely to stay that way long. They're going to sync up. One's going to start following the other. And so the question is the NASDAQ going to rebound and go with the yen? Well, given how we ended last week, I think that there's a strong chance that will happen. However, the big thing is Tesla is reporting their earnings tonight after the market closes. I think that the market will probably be optimistic through the day today, coming into Tesla's earnings. But then we're going to really want to watch how the market responds, regardless of what the news is. Most companies that have reported so far have beaten their earnings estimates, and many of them not by a little, but a lot. And yet we don't have the markets flying higher. Probably 8 out of 10 stocks that I've been watching have really good news, but then they sold off on that day. Now they might go up or down the next day, but on the day of earnings itself, they sell off even after this fantastic news. Why is that? That's this that behavior is encapsulated by this idea of buy the rumor, sell the news. Okay, that's what people say. So uh, current format is good. Thanks, sweetie. So what does that look like? Well, I'm going to be showing you a few charts. Well, let's start with Tesla here about earnings. But for right now, as you can see, Tesla's sort of trending it's been in a larger perspective trending lower, but more recently, past couple of months, maybe month and a half, been trending upward. And so as it trends upward, our our expectation is people are thinking good news is coming, but it might be that these guys that had been selling out here, taking profits because they bought Tesla much lower. As the price comes up, they're thinking, I want to hear good news so I can take my profit because I don't want to be in Tesla, right? If a hedge fund or a large institutional investor feels like they want to liquidate their positions in Tesla or in any large stock, they can't just dump a million shares. If they do, they'll really tank the market. We saw that with CBS Viacom earlier this year. A hedge fund had to get out, and within 2 or 3 days, the stock is down. Oh, good. Ellen says this format's good on both computer and the phone. Nice to know. Uh, the stock just dropped 40%. So that kind of thing can happen. Well, all right. What's going to happen with Tesla is people aren't going to crash it. It's not going to go down 40%. But if it drops, it will be because, I mean, if there were good news, people were hoping that, hey, good news is going to bring more buyers in. So now we can sell and we can sell a bunch of shares, but the stock price won't go down as much. That's the hope. Well, that's what a lot of people have been doing. These institutions have been doing over the past couple of weeks since earnings season started. And so because that has been going on, I'm really expecting to see some of that in Tesla too. And there's a bigger reason, of course, and that's the whole doomsday trade thing that I've been telling you about. But we'll get to that. Now, um, before we go any further, I think it's now time to introduce my guest to you, Lincoln Holbrook. Holbrook, Lincoln, are you there? Can you light your mic and bring yourself on?
I'm here. Good morning.
Good morning, Lincoln. Thanks for joining us. So, to everybody, just let me do a little bit of an introduction more than I did. Lincoln Holbrook has been involved in the work of coaching individuals, learning how to trade either one on one or small groups. And he's been doing this for a long time. He was one of the early instructors, both in person and over the phone, who would teach students. With Invest Tools. This was long before anybody knew what Invest Tools was or who they were, and before they became, a very widely recognized trading um, education center. I like to take credit for that. But maybe a lot of you don't know here, I was the actual content director for 4 or 5 years during the period of time right before they bought Thinkorswim, and then also during the time when TD Ameritrade bought both of them. So for about a 5 year period there, I was in charge of all the educational content and the writing of the stuff on the websites. And uh, I like to feel like we took it to a very serious next level from that period of time. But Lincoln was there even before me, and so that's not how we actually know each other. But we've been working on a few things lately together that are really exciting. We are excited to be able to bring stuff to people, and he has a website through which he is offering coaching opportunities as well. And so that's a little bit about Lincoln. And so Lincoln, with that as an introduction, welcome. I am hoping that you have an opportunity here to sort of talk about what you feel is most worthwhile in, um, you know, what's the most helpful thing for students to learn, or things that you find really do help students when you coach them. There, let me say it that way.
That's a great question. One of the reasons I have really enjoyed working with you, Gordon, is the fact that for 20 years previously to really working with you, I taught people very specific methods for how they can make money in the markets. And at Invest Tools and other places, we try to simplify it as much as possible. Kind of the green arrows, red, buy on the green arrows, sell on the red arrows, and just try to take any sort of emotion out of it. What I found is very few people would follow through. They would actually, they would really struggle. Whenever they had a loss in the market, they doubted the system and they stopped following the system. They tried to second guess the system, or they doubted their abilities to be consistently profitable in the markets. And so what I've loved about working with you is just the idea that there are probabilities associated with randomness, and you can create order out of randomness, not by where you get your entry points really so much as by where you set your exits. So I believe that, you know, sometimes it's easy to say as an instructor, well, just do what I tell you. And people struggle sometimes to just do what they're told because they don't trust themselves, they don't trust the system. And so I encourage everyone on here. Gordon teaches a system. He and I have been working on some stuff, and it was like a revelation when he first came to me. And I just knew we had to somehow get this out into the world. And so he and I have been working pretty consistently at this for the last year and a half now, just trying to get something together that gives people a system that they can be confident in. You will have losses, and that's expected. It's having an expectation and having the confidence to trust that expectation through the losses, to get out when you're supposed to get out on the profits. Sometimes people have a profit and they end up taking a loss because they don't know how to take the profit. And so it's just, for me, I guess, real quick, Gordon, it's just having a system, trusting the system, trusting your ability to follow the system, and just let the market do what it does. It's random, but you can still have profits from the randomness if you have a system that you follow consistently.
Excellent. Thanks, Lincoln, for all that. In fact, many of you on the call right now were part of the course that I taught back in the end of January, where I introduced the idea of a trading personality and a trading style that matches your personality. That is something that came about from, or it was refined between Lincoln and I, as he mentioned, over the past year and a half. And so Lincoln's, you know, approach is the same as mine in terms of that idea that, you know, you've got the little styles, the uh, hunting dog or the falcon or the jaguar. Paul has taken those up as well, and so he's teaching those particular um, uh, personas or trading styles. But what they boil down to is the idea that you can choose the preference. Just like Lincoln said, if the markets are random and you work on the ways you exit your trade, that can give you a certain degree of predictability. It may not predict profits, you need an edge for that, but it does predict your results. And within that predictability of results, in terms of, you know, the win percentage you get, then you know what to expect. And if you have the right expectations, you can tweak that and refine that and build your edge over time. And that is what the most effective training technique we have found has come about from our collaboration. But you know, another thing in conversations we had over the past year, Lincoln, and then of course last night we were talking about this. You reiterated that one of the trades you like is the diagonal spread. Would you mind taking a little bit, and I'll bring up the PowerPoint here, and then we can just sort of walk people through that, or you could walk people through that if you would, please.
Sure, thank you. So a lot of people that don't know much about the markets just think that you buy something, you know, you buy low and you sell high, and that's how you make a profit. I call that directional trading. That in order to make a profit, the market has to go in the direction that you forecast, and then you make a profit. And in the past, about 30 years ago, that's how it was. You could only really, regular people like us without huge accounts or lots of experience could just really buy stocks. That's about it. And then hold them for long periods of time, hoping that they would go up. And that's where I think a lot of people became the kind of the buy, then hope, wish, and pray that the stock would move in the direction that they forecast. But with options, over the last 30 years, the option market has actually become a very big part of the market, a very liquid, easily tradable part of the market. And while option strategies can be, and tactics to play options, they can be directional. You can buy a call option and expect that, and if the stock goes up in the direction that you forecast, you'll make money, a higher percentage of gain than you would if you just bought the stock. You can also buy an option that allows you to make money if the stocks go down in value, which I think is also pretty cool. That allows regular people to play the downside. Gordon's been talking about this idea of the markets are really going to take a dive, and in the past, people really weren't able to participate in that, but now they can by buying a directional put option. But there's a strategy that I like even better than those. Even though you can make very high percentage gains with those strategies, the chances they have to overcome some issues. One is the move has to happen within the time frame that you purchased, and the second is there is an element of time decay. And if you pay too much for time, even if the stock moved in the direction that you forecast, you might end up still losing money or not making very much money. And so what I like even better is the diagonal, which is where you buy, because it leverages the power of options on both sides of the trade. This is where you buy an in-the-money call option, and then you sell an at or just out of the money call option against it. It's kind of like a covered call on steroids. And what I love about this strategy is it's a robust strategy. You do cap your upside potential, but you're able to give yourself a paycheck on a regular basis, and you could choose weekly paychecks, monthly paychecks. The size of the paycheck will adjust depending on how much time you choose to sell. But the idea here is, look, I don't really have to know if the markets are going to go up or down. They could go flat for all I care, and I'll still be making consistent money. I kind of liken this to the idea of a three-dimensional it's a three-directional trade. It can go up, it can make money when the stocks are going up, it can make money when stocks are going down, as long as they don't go down terribly far, really fast. And it can make money when stocks are going sideways. It's a great strategy. This is not you're not going to be a gold, you're not hunting for gold in the same way. You're selling shovels to the gold hunters. And it's just a more consistent way to generate profits from the markets. And I love that strategy. It's a robust strategy. I teach it to all my students. Most people, it blows their minds, the potential for profits without the same kind of risks, or with less risk in my mind than you would take if you were trying to do directionally. So I love that strategy. It is a cash flow strategy. You're not going to get super rich really fast overnight with a big trade like that, but it is one of those, it can just be paying you paychecks all the time. I had a friend of mine, actually, one of the owners of Invest Tools. He used this strategy. He'd always just, instead of buying a new car, paying cash for it, he just put money in the markets, and then he used this covered call strategy to generate a cash flow, and then he would use that cash flow to pay for the car. That's the only way he bought stuff, is by he put money in the markets and then used the cash from the strategy to pay for whatever it is he was going to pay for. So it's a really interesting strategy, can be used in a lot of creative ways, and it's super robust as well.
Excellent, thanks. So I have an example here. I'm going to share this. If you were looking at, if you were bullish on gold right now, as an example, I think we've seen gold trend down, all of a sudden sort of turn around just about the same time that U.S. interest rates have dropped. And so if you think that there's a long-term upward play for gold in the next few months, one of the things you could do, I mean, the very best time to do a diagonal call spread would be when the market is, whatever stock or market that you're following and you're going to trade on, is trending slowly higher, and has the potential to trend, very strongly higher. Well, that's the best. If you do that, as an example, if gold were to do that, one thing you could do is you could take options on GLD, which actually has very good liquid options, and you could buy a GLD July call, $166 strike price for $4.65, and then you would sell the May call for 91 cents, right? So basically what you're doing is you're buying at the money, but 166 is about where GLD closed on Friday. When the market opens here in a bit, if you were to go after the July call, it would be maybe a little bit less than this, maybe a little more, depending on what GLD does right at the open, and $4.65. So you pay something close to that, and then you collect for a closer in option. but that's further out of the money. It's higher strike price. So in other words, it's $5 higher. Now I chose $5 higher because the implied volatility right now is priced to move $5.50. That is, option market makers think that there is a 70% chance that GLD is going to stay inside 5.5 between now and May expiration. So perfect. I'm going to go ahead and sell that one because I've got a better than even chance that I'm not going to get that thing called away from me. And I'm going to be able to keep that 91 cents. So as long as GLD is below 171 at expiration on May, then I keep that 91 cents. If I keep that 91 cents, that takes off, from 465, that reduces my cost basis. Plus, if GLD goes up, then the 465 is going to become worth more. So I'm going to get it both ways. I'm going to get it from the price appreciation. Maybe by then GLD is, the GLD July option is somewhere around $5.50 instead of 4.5. But I've also collected the 91 cents time decay. This option, this 171 option decay went to zero in value. And so I collected that. So in that way, I'm not losing money to time decay. I'm gaining money from it. Plus, if the price goes in my favor. Now, if it doesn't, what am I risking? I'm going to risk $4.65. But if it goes down, that's the most I can lose, 465 per share. But if it goes down and I lose everything, then I would still keep the 91. So I'm not really risking 465, risking something more like 374. So about $3.75 per share, or in other words, $375 per contract. That is the initial risk. But if I do this, the great thing about the diagonal spread is you can do this over multiple iterations. So check this out. If I buy the call, these are pointing to the expiration day. If I buy the 166 call, and it's going to expire clear out there in July, but I sell a 171 for May, and then a 173 for June, then a 175 for July. This is assuming that it's drifting higher over the next couple of months. Then I might be able to pick up as much as $3 credit. And that's just hypothetical. But if I were to pick up $3 credit, then I would only have a net risk of $165 per contract. Meanwhile, if I let that go all the way up to 175, I could be making $9 per contract total from the 166 that I originally bought. So I basically created a trade. If I plan this out, and I'm going to do all three of these, if I plan this out, I have a trade where I could risk a certain amount, $1.65 or $165 contract, and I could get 4 or 5 times that over 3 months. And it's not a 20% risk trade. It's more like a 50-50 trade. So it's a 50-50 trade, but it pays a lot when it wins and loses a little when it loses. I mean, if you don't know that much about options, I hope that this will inspire you to want to learn. I've got a class coming up that I'll be teaching at the end of May. And this idea alone, if this is the only thing you learn from it, would more than pay for the cost of a class in a single trade. But there's going to be something in that class in each hour that is equally valuable. And I want to tell you that if you are interested in trading options, and if you even have as little as $1,000 that you want to put towards trading options, you'd be crazy not to take this class. It would be very worth your while because I'm going to show you how you can do trades like this. Lincoln.
Hey, Gordon.
Yes, go ahead.
Sorry to interrupt, but I just wanted to talk about leverage. Some people do covered calls on stocks, but the percentage gains on covered calls on calls that you purchased are much, much higher. And that leverage is what makes this little strategy so amazing. It's you might not think 91 cents is that much, but when you consider the percentage gain on the original investment of 465, that's a really high percentage gain. And you can do that 3 times, before you even get to the end of the expiration. So there's some consideration there that makes this strategy so amazing, and that's the leverage associated with these options.
Yes, it's true. It's true. This particular strategy. In fact, thanks for mentioning that, Lincoln, because one of the things I want to show is what Lincoln brought to us was an example of, or what he was describing was a bullish diagonal spread trade. But you can actually do this trade bearish. And since I am feeling like doomsday is coming on May 14th, and when I say doomsday, I mean a significant sell-off might be just small. The smaller it is, the bigger the upside on the other side of it. But I'm thinking there could be as much as a 20% downward draft in the markets, and that's to the market indexes. So, this would be the start of a bear market if it continued. But it could be that serious, and that will come on or around May 14th. Not necessarily start right there. It could start a couple of weeks, and from whatever peak we go, that sort of thing. But the markets are setting up very nicely for that because they're very nervous. You can see they're nervous, but they're getting calmer and calmer and calmer, and that is fantastic. Because if the markets are really calm and all of a sudden, boom, something bad happens. Well, that means you can buy, if you buy in ahead of time, you can buy low priced options, put options that will all of a sudden get very expensive as the panic starts. I want to show you how you could take advantage of that same trade. This is what I was referring to as the doomsday trade. So I mentioned this before, but now that we've gone through the diagonal spread, I'm going to show you how to do it with put options real quick here. So here's the chart. This is just the context of the chart. Shukri, IWM, yes, there it is. That's right. This is the Russell 2000, and of all the major indexes, this one is the weakest. So if the markets collapse and go bad like I'm expecting them to, this one is going to have the worst time of it. Well, for a couple of reasons. One, because it's small cap stocks and they're riskier stocks. And if people are afraid, they're going to pull their money out of this stuff first and fastest. But the second reason is, well, it's already weaker. The NASDAQ is back up to a new high. The S&P 500 and the Dow Jones Industrials, they're all hitting new highs. Not the IWM, not the Russell 2000. It has got a head and shoulders kind of pattern underway. And so I'm expecting it to go down. Now, we talked about the idea that you buy a put option with some time, some significant time out and then you sell. You buy an option, whether call or put. In this case, it's going to be put. So we're going to buy a put option. I think that IWM could make it down into the 180s, but even 200s are really cheap. So I'm buying. In fact, I've already bought the July 200 put option, and I'm going to sell put options against it, just like Lincoln was saying, collect a little bit. But I'm not going to wait for once a month. I'm going to do it every week, all the way down. Yeah, check this out. You're going to love this, I hope. Anyway, so that's the plan. Now, I'm going to show you how I've already begun to implement that plan. Here is the spreadsheet. I do what I teach my students to do. I have a trading plan. My trading plan is really simple. I don't want to go through 100 pages. This is specifically for this trade and this strategy and this kind of trade. It's one of the three strategies I work with at any given time, and that is these calendar and diagonal spreads. Okay, they might start as a calendar, but then they shift to diagonal anyway, whatever. So I'm going to use my opinion on directions to initiate these calendar spreads. I'm going to buy 2 to 3 months of times with 30 deltas or lower, and then I'm going to sell weekly options to reduce the cost basis below zero if possible. I want to risk no more than 50% of the initial capital in the trade, and then I want to sell out of the money strikes each week. And I want to target 12 to 18% of the initial price when I first get started. So here we go. This is what I did a couple of weeks ago. I bought the put option, the July 210 put option. I'm targeting that move down to 200 at least. And if it goes past, makes to 200, I'm great. If it makes to 180, I'm rolling it. It's going to be fantastic. I don't know that it will, but I think it could get there really easily. So, but even if it doesn't, even if all it gets to is 200, I'm set. So I bought the 210 for July expiration. The price at the time was $2.95. So $2.95, and I did 3 contracts, so I got a cost of $882 on that. 50% risk of that is going to be $441. That's how much I'm willing to lose in this particular trade. Just $441. That's hardly anything, but that's what makes this so fun, because it's small. I don't care about it. It could still go quite big. So the very first thing I sold was the April 16th expiration, and it was a 218 strike. So it's much higher. The strike that I'm selling is much higher than the one I bought. I'm going to sell this at 218. I get 36 cents for it. And at 3, that's $108 that I collected for that. And so if I take that $108 off the 441, that means my risk is now only $333, assuming that it expires above that level. As long as IWM expires above 218, then I get to keep that. Well, it did. That was last week, actually the week before, and I collected that. And so, all right, banked $108 on that. Next week, this past week, I did it again, and I got 38 cents this time, and I sold the 214s. Now, when stocks dropped like that earlier in the week, I got a little nervous, because it got down like 215-ish or something, but it jumped right back up. No worries. I did not get no chance of losing that trade, getting executed. But this is why I always go, that level and that's one of the things I teach in the classes. How do you know exactly where that is? Where's a good level that you can stay with? Well, it's not hard to find. You got to have the right data to look at, but it's not hard. So anyway, I did 214, and it expired above that. So I have now collected $108 and 114, a total of $222. And my initial risk was only 441. Here we are, only 2 weeks into the trade, and my risk is down to $200. If this trade goes the worst it could possibly go, the most I could possibly lose is $221. Actually, 239, yeah, 219. That's the most I could lose from this point forward. But what I'm going to be doing today is selling another one further down. It'll probably be actually higher up, because IWM is closer. So I'll probably be selling something like yeah. So we got IWM clear up here at 226. I'll probably be selling down here 214, 215. We'll see whichever one gives me about 30 cents that I can get for the week. And if I collect that again, that's another $100. Look at this. If I do this every week, collect $100 on that trade, I've still got, what, 12 weeks ahead of me, possibly 10 to 12 weeks possible that I could be collecting on that. If I'm collecting $100 each way, well, by the time I get to the end, I could have collected as much as $1,400. No, not sorry, $1,200. I only had $800 in capital that I needed to tie up to make this, and that is, subsequently the total risk I'm taking. I only wanted to take half of it, so if it goes that bad, goes against me, I just get out. But the thing is, I could end up making $1,200 on $800 during a 3-month period. That is a 50% gain. Now, if I put my whole account into it, then of course I could lose my whole account. So I'm not going to do that. But on the money that I'm investing, this thing is going to give me 50% return just from the puts that I'm going to be selling against it. Assuming it works out, perfectly, and it always, dips down and goes lower and lower. I mean, it doesn't go as low as fast. In fact, this actually works even if I'm wrong about the underlying. If I keep selling these and I just keep selling the put options, even if this goes up and up and up, I can still make all that money by making 50% gain. Can you imagine putting on a trade and being wrong and making 50% return on it. That's what this trade is. Now, what happens if I'm right? I'll be making some of these to reduce my cost basis, but at some point, if all of a sudden IWM starts dropping really fast through here, like it did, look at that. See, in just in a week or two, we saw this huge drop. That was almost a 10% drop in the IWM just in a week. That kind of thing could easily happen in the next couple of months sometime, when May 14th hits. And if in fact it does, well, I might not sell on that week, or I might feel like, hey, it's starting. I'm going to go ahead and take this off, take a loss on one of these, and then just let it ride. Because that's the thing. Lincoln mentioned, if you got this trade on all the time, you've capped your gains. But if you have the ability, as in this case you do, to anticipate the possibility of a big move, you see evidence that it's coming, you pull the trade off for one of the weeks, and you let it ride. And if in fact it rides down hard like that, then your your cost basis is really low, maybe 25% of what you started with, but all of a sudden you're making big gains along the way. And what could it do? Well, look at this. This is a $210 strike, okay? 210 strike. If in fact in May it drops down to 200, that's $10 per share intrinsic value that will be there, plus whatever time value. So I paid $14 for it, or $4 for it. If in fact it were worth 14, that would be $10 profit. That is a realistic scenario. So I could be capturing all this gain week by week, but then when the big drop happens, back off, let it drop, and then I would have as much as $10 per share on that contract. So I could be making, with $10 a share, I'm making $1,000. So that's $1,000 over and above whatever other profit I've already made. Think about that. I get to a situation like right now, I only have $200 risk, and that one move is going to potentially create the opportunity for anywhere from $1,000 to $1,500 in profit. And that's not the end of the trade. It can keep going even lower if in fact, the market decides that it's panicky and so forth. But in whatever way we're talking about, uh, this is a trade that has $200 risk, and let's call it $1,400. That's 7 to 1. That's a 7 to 1 risk reward ratio. Um, yeah. So anyway, that's the explanation. Hopefully that made sense to you. That is the Doomsday Trade I'm working on. I'm going to show it to you if I can, week by week. And hey, if I lose money on it, I'm not going to be afraid to tell it to you. I'll just show you week by week the entries. The next week, this next leg of the trade, which starts today, I'm going to try and put that on at another 30 something cents. That's going to be my target. Okay, so fun and games. Don't fail to come back week after week and see how this is going to play out for me, whether or not I'm going to be making money on this or not. But I think that my chances are pretty high. Shukri has a question. Good to have you here. Shukri, I'm going to have you on as a guest to talk about the cryptocurrency stuff, I think, and maybe some of your trading stuff. Shukri has a question. So once it goes down, you want to catch an upswing late in May or whatever, will you use IWM or NASDAQ? All right. So what Shukri's talking about is if in fact we get this big drawdown and it happens like I think it's going to happen, but it's short, say it only lasts 2-3 weeks. Well, if it only lasts 2 or 3 weeks and it only drops 10% or less, then I know that what's coming after is likely to be a pretty good upward move. So I want in on that. That's the dip I absolutely want to be a buyer for. And so which one would I pick? Would I just jump on the NASDAQ or the IWM? Well, okay. The question is perfect. And the answer is it depends. And what it depends on is when those indexes start to rebound, I want to look and see which one rebounds the strongest on a percentage basis. Because there's no set rule for that. It's just what do investors think is going to happen. Now, if investors feel like, hey, that was nothing. It was like COVID. Jump in. Things are really going to move from here. well, then it's most likely that IWM will be the leader coming out the gate. If they're a little nervous, but they still want to be eager and jump in and buy, then it's going to be the NASDAQ. If they're really nervous, they're like, well, I want to buy, but I want something safe, then it's going to be the S&P 500 or the Dow Jones, right? So one of those four, I'm going to watch for and see on a relative strength basis which one does the best coming off the bottom, and I'm going to jump in that to be bullish on. Now, I will also say if it's IWM, that means the upward move is probably going to be stronger and longer. If it's Dow Jones, the stodgiest, slowest group of companies, the ones that pay dividends, then that means people aren't really convinced that the bull market's going to continue and they're worried. And that means it's probably going to go up a little bit and go down again. There's going to be another leg down. If in fact the Dow is the leader coming out of that, it means people are still scared, and any tiny little bit of bad news is going to trigger another wave of selling. So I anticipate that if in fact, as Shukri is asking, it's going to be a short-lived kind of thing, then what we're going to see is the markets come down and see IWM or NASDAQ QQQ making a big move off the bottom. And I kind of think it's going to be the NASDAQ. So hopefully that answer question. Does that sounded like magic, Gordon? Did you say 50% of the account or just one stock? No, it would just be the one trade that you did, Helen. But if you put your entire account into it, then yeah, it'd be 50%. You don't want to do that because if you're wrong, you could lose your whole account, right? However, if in fact you get comfortable and um, good at this, then although you're making 50%, okay, still not sure I understand how you did it. Okay, well, then keep coming back week after week, Helen, and watch, and I'll be showing to you how it gets implemented. But the idea is pretty simple. I'm going to buy a put option, and that put option is going to get more and more valuable if the market goes down. And then each week, I'm going to try to collect a little bit by selling a put option against it. It's kind of like a covered call strategy upside down. So a covered call, you buy a stock, you're trying to expect the stock goes up, and then all along the way, you're selling a call option against it. You hope it doesn't go up quite as far as where you sell the covered call, because that way you get to keep that money. It's like you're renting out the stock, so to speak. That's not even a good analogy, though. Really, what it is you're offering people, hey, here's a lottery ticket. Buy this option from me, and then if the stock runs up, you're going to make a lot of money. But in fact, you don't get to keep you don't win the money if the stock doesn't go above. So you're selling a lottery ticket. Most lottery tickets don't pay. If you're selling lottery tickets, you get to keep the money they pay for the lottery ticket, right? That's the idea behind covered calls. Now you could lose, somebody could hit the numbers and then you got to pay out. Thankfully, you don't have to pay out as heavy as a lottery does, but you would have to pay out the stock. Well, that's not a problem if you own the stock, right? You just give them the stock. And whatever the distance is between where you sold it and where the strike price was, you'll still be making profit. So that's what the cover call strategy is. Well, what if instead of owning the stock, you owned an option? You owned a call option, okay? And then you sold a higher call option against it. Well, if they say, I think it's going to get up here, and you say, go ahead, I'll sell that to you, and it doesn't get there, you get to keep their money. But you have this other call option just in case it does get way up there. Because if it does get way up there, then you got to give them the stock. How are you going to get the stock? You're going to exercise your call option. And then you get to keep the difference in between. That's what the covered call trade, that's what the diagonal spread trade that Lincoln introduced us to. Now I'm taking that and flipping it upside down and saying, okay, I want to do the same thing, but with a put option. I think the stock's going to go down. So I'm going to sell a put option, or I'm going to buy a put option. So if it does, I'll win. But along the way, I'm going to sell put options, lower put options than the price is, but not as low as where I am. And so I'm just going to sell a little bit, little bit, little bit. I'm going to collect a little bit all along the way. I'm going to sell these put option lottery tickets. Meanwhile, I'm going to hold my own lottery ticket that's longer and further out in time. That's the explanation. I hope that helps you understand a little bit better. But as I say, Helen, we're going to be going through this each of the weeks. And if you really want to fully understand it, then be sure and take my class late in May, because we're going to walk through that step by step and give you the ability to track it by learning the strategy in detail. But you're going to watch me implement the strategy, and hopefully you'll be able to pick that up as we go. All right. Well, we've got just a few minutes before the market opens, and I want to talk to you about earnings. This is the big week for earnings, the big week. So here I just got 4 stocks. Facebook is the one highlighted down here in the corner. Apple and Microsoft. So the first one is Tesla. Tesla happens today at the end of the market close, right? That's Tesla today. Tomorrow, Google and Microsoft both report after the bell. And then the day after that, Apple and then Facebook. So that's Wednesday. On Thursday, it's Amazon. This is the FANG stocks minus Netflix. Netflix reported a couple of weeks ago. And what these 6 stocks do, the rest of the market is going to follow. I mean, in general, right? There will be differences on individual stock by stock, but we really want to watch these 5 stocks this week and see how they play out. We want to see if, in fact, we see more of that same kind of thing I'm describing, a great earnings announcement, but people sell off anyway. I anticipate that every single one of these earnings is going to have, every single one of these stocks is going to have good earnings. The question is, are large investors going to sell anyway? If they do, that's just going to set us up even more for the doomsday scenario coming May 14th. Now, if you're new to us this week and you haven't been listening and you hear me, yeah, right, Shukri, all the big guys are reporting, yeah, and so if you're new to this charts and chats with me, then you may not know what I'm talking about when I refer to the doomsday scenario. Look up the link on the Actions to Wealth channel in YouTube. Go back about 3 weeks, and I lay it out, the 56-week pattern. It's 3 weeks back, so it's going to be the first week in April. First Monday of April is when we went through that, and or maybe the second, 8th. Can't remember if it's the 8th or the 1st. Anyway, you want to go through that whole thing and see very clearly what it is. I lay it out very step by step what the 56-week pattern is, why it's so highly predictive, and why it's a stealth thing. You just boom, all of a sudden wouldn't expect, and it can show up. But anyway, yeah, Shukri asks, are you looking at other listed other just listed stocks like Coinbase and Snowflake? You mean the IPOs and stuff? I'm not looking at those for earnings announcements, because those are not correlated with the rest of the market. I mean, they might go up, they might go down, but the people that are investing in them or speculating on them, they kind of have their own mindset and their own time frame. They will be affected by the markets, but not super tied to it. These 4 will be tied to the markets. All of these are better than 80%, better than 85% correlated with the S&P 500 and with the NASDAQ. So whatever these guys do, I mean, collectively, these 4 stocks right here, and they and Tesla together, they account for something like 30% of the influence of the NASDAQ 100. And if you look at how many ETFs they're a part of, hundreds. So it's more like 40 to 50% influence on the price of the NASDAQ, whatever these stocks are collectively. And so if what we really want to notice here is this: Google is hitting new highs. See, if you go back earlier in the year, that was its previous high, and now it's right up on its new high. Microsoft, same thing. Apple has not reached back to its old high. If all of a sudden all stocks are going to go upwards, you would think, oh, well, I should be buying Apple because Apple is the dip. It's the cheap one, right? No, that's not the way to think. The one you want to buy is the one that's already done the best, and that's probably going to be Microsoft. If in fact we're all going to have really good earnings, if you're bullish, if you think Gordon's crazy, doomsday, forget it, that's not happening. If that's the way you feel, then you want to watch Microsoft. If they come out with good news, then their stock is likely going to go up once the sell-off is done. I think there'll always be a sell-off on all these. It's just a matter of how strong the sell-off is. If it's really weak, you'll just see it drop and come right back up in the same day. If that were the case, Microsoft had good news, which I expect they will, then they would probably keep going, probably have a very strong move afterwards. So Microsoft is, of these four, the best one. But Facebook's also pretty good. If Microsoft has a good day, Facebook happens the next day, that's something to decision. However, if the news is bad, if Google comes out with bad news or Microsoft comes out with bad news and it sells off hard, Apple's where you want to be. And I don't mean buying Apple. I mean buying put options or selling short or somehow trying to benefit from the downward move. I have also done put calendar, the same one on IWM. I did it on Apple too. And this is why, because Apple's the weakest of these big ones. So I'm really anxious to find out, hey, what's going to happen with earnings on Apple. Now, in the case of Apple, I'm not going to sell a put option against it because with earnings, it could jump. All right, I still want the long-term put option, so I'm going to buy it. I'm going to hold that through earnings, but the sale, I'm going to wait until earnings are done, or come to think of it, I'll probably sell it and then take it off the day before they report. Let the report happen, and then get ready to get back in after the report is done. So that's the way these are looking. One of them, one to look at is Amazon. So let's pull up Amazon. This is the last one that's going to hit this week of the big ones, and Amazon's also not quite up to its old highs. So we want to watch all 5 of those stocks to see how do they perform when earnings are released. If in fact all of them, especially if all the news is good, but if the price action by the end of the week is lower for each of those, that just tells you investors are really nervous. They don't want to put more money, new money into it, and it probably is a bearish setup for what's to come in the May 14th timeframe. If in fact they're all good, the news is good, and they're all up, well, that's that that's not going to erase the doomsday scenario, but it does mean that the market is healthy and more money will probably be on its way in, and so there's less to worry about it falling. Uh, that's the big news for this week. That's what you should be watching all week long is, how are these responding to the news? Because if the news is good and people sell, it means people are nervous and it means the sentiment is bearish. If the news is bad, but people buy anyway, it means they're bullish. So that's the back and forth that we're looking for. All right, Helen says, I'm just getting the basic gist of what you're teaching. Better than before for sure. Thanks, Gordon. The lottery analogy is a good one. Glad that worked for you. All right, one more quick look back at the NASDAQ now that the markets have opened. And let's see what they're doing here. We're on the 15-minute chart. As you can see, the first one out the gate, there's the NASDAQ. It's on its way up. And okay, notice how the NASDAQ here looks just in the past couple hours like the Aussie yen. So the Aussie yen was a really good leading indicator for us to say, hey, this could possibly be a bullish upward tick. And so far it's started out that way. I think that people are going to be optimistic for Tesla's earnings. And so that throughout the day, we're probably going to see a little bit more buying than selling in the US markets. But that could all change tomorrow. And as if that weren't enough news, all this earnings news I'm talking about, the Fed is going to make an announcement on Wednesday, scheduled announcement. Everybody thinks that the announcement is going to be, we're not touching interest rates. No new news. Everything is the same. That's what everybody thinks that they should do. If they do anything other than that, if they say, well, we're seeing more inflation than we thought, or we're not seeing as much inflation as we thought, or we see this weird kind of risk out there, or nothing's going to change now, but 3 years from now, we'll probably want to do. If they do anything other than nothing to see here, folks, right? Then the markets will freak. They will panic. They will do something weird. They will sell, right? So there's, I think, less than 20% chance that that's going to happen, but it's always there. That'll happen on Wednesday, right before Apple and Facebook report. So that's it's going to be a lot of trading fluctuation that happens on Wednesday and then coming into Thursday morning. That's the week as it shapes up. Until we get back together next week, everyone take care and trade well.